The great silver squeeze is here. Why $50 is just the beginning. What if I told you that the most significant financial story of our time isn't being written in the stock market tickers or the cryptic pronouncements of central bankers? What if the real story is being forged in a metal that has been considered money for millennia, yet is now at the epicenter of a global supply-demand collision of unprecedented scale? We are witnessing a structural deficit in the global silver market now entering its fifth consecutive year, a chasm between what we consume and what we can possibly mine. This is no mere market fluctuation. It is a fundamental reordering, and the tremors are just beginning to be felt as we watch the price fight to hold a $50 per ounce floor. The prevailing economic condition we face is one of profound and deeply rooted instability. For years, investors have been navigating a minefield of expansionary monetary policies, burgeoning government debt, and the ever-present specter of inflation, which has proven far stickier than central bankers initially admitted. This environment has created a frantic search for safe haven assets, for tangible stores of value that exist outside the traditional financial system's ever-expanding ledger of liabilities. The problem is that the traditional safe havens are becoming crowded, and their efficacy is being questioned, pushing discerning investors to look for assets with both monetary history and inelastic industrial demand. This is where the silver narrative begins to diverge dramatically from all others. The opportunity that arises from this problem is immense, yet it remains obscured for many by decades of price volatility and a complex paper market that has often disconnected futures prices from physical reality. The true opportunity lies in recognizing the dual nature of silver. It is both an indispensable industrial commodity at the heart of our green energy and technological future, and a monetary metal with a 5,000-year history. This duality creates a dynamic unlike any other asset. While gold sits predominantly in vaults, silver is actively consumed, burned through in solar panels, electric vehicles, and countless electronic devices. This relentless consumption is creating a supply squeeze that cannot be resolved by price alone. The primary catalyst disrupting the long-held status quo is a powerful psychological and demographic shift, particularly in the Eastern Hemisphere. A monetary awakening is taking place. In nations like India and China, with long cultural affinities for precious metals, a new generation of investors is witnessing the erosion of purchasing power in their native currencies and are seeking refuge. This is not just a continuation of tradition, it is a calculated response to economic uncertainty. This shift is amplified by rising incomes, which are enabling millions of new households to enter the physical investment market for the first time, creating a baseline of demand that is both larger and more resilient than ever before. This monetary awakening is not simply about buying jewelry or silverware, as our parents and grandparents did. The data reveals a stunning evolution in investor behavior that caught even seasoned analysts by surprise. In India, a market many assumed was dominated by demand for ornate jewelry. A staggering 70% of total retail silver demand in 2024 was for investment-grade bullion bars. This is a profound statement. It signifies a deliberate, calculated move to acquire silver in its purest monetary form, a conscious decision to store wealth in a tangible asset rather than just adornment. This is not a cultural quirk, it is a financial revolution happening in plain sight. The second, and perhaps even more powerful, catalyst is the non-negotiable price-inelastic demand from the green industrial revolution. The global transition to a low-carbon economy is not a choice. It is an imperative backed by government mandates and trillions of dollars in planned investment. And at the heart of this transition lies silver. It is the most conductive metal on the planet, making it irreplaceable in solar panels, where its use is intensifying with new, more efficient technologies. It is a critical component in every electric vehicle, in 5G network hardware, and in a vast array of other electronic applications. This demand does not slow when the price rises. If anything, it accelerates as the green transition gains momentum. To put this industrial demand into perspective, consider the sheer scale of global ambitions. Nations are legislating the end of the internal combustion engine, and mandating massive increases in renewable energy generation. Each of these goals requires a staggering amount of physical silver that must be sourced, refined, and delivered. Unlike investment demand, which can be fickle, this industrial demand is locked. A solar panel manufacturer or an automotive company cannot simply stop production because the price of silver has doubled. They must acquire the metal, whatever the cost, to fulfill their production targets and business plans, creating a powerful and permanent upward pressure on the supply chain. The third crucial catalyst is the financial innovation that is unlocking a torrent of new capital into the silver market, especially in emerging economies. The launch of silver exchange-traded products, or ETPs, in India in 2022 is a landmark development. After a slow start, these investment vehicles have seen explosive growth. As of mid-2025, holdings in Indian silver ETPs had skyrocketed by over 50% since the end of 2024, reaching a colossal 58 million ounces. This innovation provides a seamless bridge for investors who are active in the equities market, but might have been hesitant to deal with the logistics of buying and storing physical metal, thereby opening the silver market to a vast, new pool of sophisticated capital. The tipping point in a market like this is the moment when the illusion of the paper market shatters against the rocks of physical reality. For years, the price of silver has been largely determined in the futures markets of the COMEX and the LBMA, where the amount of paper claims on silver often exceeds the actual physical metal in their vaults by orders of magnitude. The tipping point will arrive when a critical mass of industrial users and large institutional investors, frustrated by delivery delays and concerns about the integrity of the paper market, decide to bypass this system entirely. They will seek to secure their future supply by going directly to the source, the miners and refiners. We are already seeing the precursors to this event. Reports of continued delivery issues between the major trading hubs of London and New York are not mere logistical hiccups. They are symptoms of a system under immense strain. The analogy of the earth being 70% water, but a person dying of thirst in the desert is exceptionally fitting. There may be silver in vaults, but if it cannot be delivered to the place where it is needed, at the time it is needed, it might as well not exist. This is the essence of a squeeze, and it is moving from a theoretical risk to an imminent probability as the structural deficit deepens and trust in the paper system erodes. The crisis will likely be triggered not by a single cataclysmic event, but by a cascade of delivery defaults. Imagine a scenario in the near future, perhaps in late 2025 or early 2026, where a major industrial consumer stands for delivery on a futures contract and is met with a notice of force majeure or is offered a cash settlement at a premium. The news would spread through the industry like wildfire. The signal would be unmistakable. The paper promises can no longer be trusted. This would incite a panic, a frantic scramble among all industrial users to secure physical inventory, creating a bidding war that would leave the paper price completely disconnected from reality. The immediate impact of such a decoupling would be a violent and rapid repricing of silver to a level that reflects its true scarcity. The peak of nearly $55 an ounce seen in October 2025 would not be a ceiling, but a distant memory, a mere base camp on the way to a new summit. We would be looking at a potential move into a three-digit price per ounce, not as a speculative fantasy, but as a mathematical necessity to balance a market in profound deficit. This repricing would be disruptive, chaotic, and for those unprepared, financially devastating. It would represent one of the most significant wealth transfers of the modern era. The aftermath of this repricing would reshape the financial and industrial landscape. For the green energy sector, it would mean a dramatic increase in the cost of producing solar panels and electric vehicles, potentially slowing the pace of the transition or requiring even greater government subsidies. Electronics manufacturers would face a margin crisis, forcing them to either absorb the costs or pass them on to consumers, fueling further inflation. The very foundations of our technologically advanced society would be shaken by the newfound expense of one of its most critical and irreplaceable components. Geopolitically, the consequences would be immense. Nations rich in silver resources, such as Mexico, Peru, and China, would see their economic and political power swell overnight. We could expect the rise of resource nationalism, with governments imposing new taxes, royalties, or even export restrictions to capitalize on their newfound leverage. The global supply chain, already fragile, would become a battleground for strategic resources, with nations viewing their silver reserves not just as a commodity, but as a critical national security asset. This would add a new layer of complexity and tension to an already fragmented global political order. In the precious metals complex itself, the great rebalancing would finally occur. The gold-to-silver ratio, which has lingered at historically high levels above 80, would begin a precipitous fall. This ratio is a measure of how many ounces of silver it takes to buy 1 ounce of gold. A falling ratio signifies silver outperforming gold. As the market awakens to silver's critical industrial role and its extreme physical scarcity, the ratio would likely not just normalize, but could plummet towards its historical mean, which sits closer to 15 or 20 to 1. This implies a potential for silver's value to appreciate at a rate 4 to 5 times that of gold. This is not merely a theoretical exercise based on historical charts. The dynamics driving this potential shift in the gold-to-silver ratio are rooted in the fundamental differences between the two metals in the 21st century. While both serve as monetary assets, only silver is an essential, consumed industrial commodity at the heart of the world's most important technological trends. Gold is primarily hoarded, meaning the vast majority ever mined still exists in an accessible form. Silver is consumed and discarded, meaning its available stockpile is constantly being depleted, making the supply-demand deficit a far more acute and explosive issue. The implications for individual investors are profound. Those who have viewed silver as a mere commodity or a volatile trading vehicle will be forced to reconsider. The new reality will position silver as a core strategic holding, a unique asset class that offers protection from currency debasement while simultaneously providing exposure to the most powerful technological and environmental trends of our time. The distinction between owning physical silver and holding a paper claim on silver will become paramount. In the aftermath of the tipping point, possession will be everything, and the value of unencumbered physical metal will command a premium that is unimaginable today. The surge in American demand for silver also tells a compelling, albeit different, story. While the U.S. has traditionally been the largest physical investment market, the nature of its demand is multifaceted. It is a story of consumption on a grand scale. Every smartphone, television, and electric vehicle purchased by an American consumer contains silver, contributing to the demand side of the ledger. This, combined with a robust community of private investors, or stackers, who can often afford to acquire larger quantities due to higher disposable incomes compared to their emerging market counterparts, creates a powerful pillar of demand in the Western Hemisphere. However, it is the comparison between the Western and Eastern investor that reveals the true depth of the global movement. While an American investor might purchase a 100-ounce bar, the per capita participation in India is likely far greater, creating a broader and more resilient base of support. The Indian investor buying a 10-ounce bar and the American investor buying a 100-ounce bar are responding to the same global anxieties about wealth preservation and currency debasement. It is a synchronized global movement, a grassroots rejection of a failing monetary experiment, and it is gaining momentum daily. The future trajectory of silver's price will be influenced by several key macroeconomic factors in the coming months and years. The tariff policies of a new U.S. administration could introduce further volatility and supply chain disruptions, potentially impacting the cost and availability of refined silver. Moreover, any move by the U.S. Federal Reserve to cut interest rates would be exceptionally bullish for precious metals. Lower interest rates decrease the opportunity cost of holding non-yielding assets like silver and gold, making them more attractive to institutional investors, while also signaling a weaker economic outlook, which further enhances their safe haven appeal. It is critical to understand that the current pause we are witnessing in the silver market, the consolidation around the $50 per ounce level, is not a sign of weakness. It is the market taking a necessary breath after a monumental 65% surge in 2025. This is a period of base building, of establishing a new and much higher floor before the next inevitable leg up. Markets do not move in a straight line, but the underlying fundamentals of the deepening supply deficit and accelerating demand have not changed. This pause is a temporary condition in what is shaping up to be a long-term secular bull market. Therefore, the prediction that it is highly unlikely for silver to fall below $40 an ounce before the year's end is not born from blind optimism, but from a sober analysis of these powerful underlying forces. The combination of relentless industrial consumption, a monetary awakening in the East, and growing investment demand in the West creates a trifecta of support that is incredibly robust. To see a significant price collapse would require a sudden resolution of the supply deficit, a feat that is geologically and logistically impossible in the short term, or a complete evaporation of investment and industrial demand, an equally improbable scenario in our current economic and technological climate. The market is getting tighter by every conceivable metric. Mine supply has been stagnant for years, struggling to keep pace with demand even before the recent acceleration. Above-ground stockpiles are being relentlessly drawn down. The fact that this is the fifth consecutive year where consumption has outstripped production is a stark warning. Each year the deficit continues, the buffer of available inventory shrinks, bringing us closer to the day of reckoning, the tipping point where the system can no longer bridge the gap between paper promises and physical availability. We are approaching that day much faster than most market participants realize. This brings us to the ultimate takeaway from this analysis. The long-term significance of what is happening in the silver market extends far beyond the potential for investment gains. It is a powerful lesson in the enduring principle that physical reality will always, eventually, triumph over financial abstraction. For decades, the true value of silver has been obscured by a complex and leveraged paper market that allowed for price suppression. That era is drawing to a close, not because of a conspiracy, but because of the undeniable weight of real-world physical demand. The enduring lesson is that in a world of infinite digital currency creation, finite and essential tangible assets will ultimately become the final arbiters of value. Silver's unique position as both an essential industrial commodity for our future and a trusted monetary asset from our past places it at the absolute center of this paradigm shift. It is not merely a hedge against the problems of the old system, like inflation and debt. It is a direct claim on the essential building blocks of the new economy that is emerging. Investors must therefore fundamentally reevaluate their perception of silver. It should no longer be relegated to the fringe of a portfolio as a speculative play. Instead, it merits consideration as a core strategic holding, an insurance policy against systemic financial risk, and a direct investment in the inescapable technological and environmental trends that will define the coming decades. The allocation to physical silver is an allocation to the tangible, a vote of no confidence in the intangible, and a position in the most asymmetric investment opportunity of our generation. The future we are heading towards is one where the demand for silver is no longer a variable, but a constant. As the global population grows and modernizes, and as we push deeper into the green energy transition, the baseline of demand will only increase. Meanwhile, the supply side remains constrained by the geological realities of mining and the years of underinvestment in exploration and development, caused by artificially suppressed prices. This is the perfect storm for a sustained and dramatic revaluation, a process that has already begun but is still in its early innings. The shocking truth is not that silver is rallying, but that it remains so profoundly undervalued relative to its fundamental importance. The fact that over 500 million ounces are consumed annually into a deficit is a market signal of profound importance. The explosive growth of investment vehicles in places like India demonstrates that the world is waking up to this reality. The financial world is about to be reminded of a very old lesson. The law of supply and demand is not a suggestion, it is an unbreakable force, and that force is now firmly on the side of silver. The consolidation we see today is the market coiling for its next major move. As geopolitical uncertainties persist, as central banks continue to grapple with an untenable debt situation. And as the green revolution marches forward, the catalyst for silver will only intensify. The question is not if silver will break out from its current range, but when and how violently. The evidence suggests that the next phase of this bull market will be even more powerful than the last, as the physical supply constraints become undeniable to even the most skeptical market observers. In conclusion, we are standing at a historic juncture for this critical metal. The narrative is no longer one of mere speculation, but of fundamental, structural, and irreversible change. The convergence of a global monetary awakening, an inelastic and accelerating industrial demand, and the financialization of new markets has created a powerful and enduring tailwind. The coming years will see silver reclaim its historic role as a premier monetary asset, while simultaneously solidifying its position as the indispensable element of the 21st century technological age. The shock is not what we have heard about silver. The shock will be for those who failed to listen.